If you're concerned about the prospect of a stock market crash and would like to receive substantial downside protection, then this video may be for you. If you would like to see a portfolio example for a different dollar amount, then just leave that in the comment section and I will see if I can accommodate. In today's video, I will walk you through a $2.5 million hedged income stock portfolio. What does that mean? Hedged means that there is a degree of downside protection. Hedged income means that you actually receive income while receiving the downside protection also. What's the catch? The catch is that your total return potential or upside potential is limited to a specified amount, which I will show you in a moment. This portfolio is invested for a time period of 2 years and generates hedged income of $389,840 while receiving downside protection of 35.7%. This means that come hedge expiration in 2 years, if portfolio shares on a weighted average basis have fallen, they have to fall more than 35.7% for this portfolio to lose money. How does this work? Let's take a look. The strategy I'm about to show you is called selling cash secured puts. What this means is that our investment advisor firm structures a hedged income stock portfolio for you, whereby initially you do not own any stocks. Instead, what you do is your brokerage account holds cash. We then sell dozens of individual hedging contracts for dozens of individual stocks diversified across various industries. You hold cash today, and we sell hedging contracts, which mean that if shares come hedge expiration in a time period, which in this case is 2 years, close below a specified level called a strike price, then you'll be forced to buy shares at that time at that price, even if shares are trading at a lower price in the market. The benefit to the strategy is that your contractual purchase price is lower than where shares are trading today. If come hedge expiration in 2 years, shares are not trading below this contractual purchase price, then you do not buy shares and instead you keep hedged income that you receive in exchange for entering into these hedging contracts. Let me explain with some numbers behind me. In this portfolio example, which was recently posted to our website at bespoketfc.com, your portfolio holds cash. Hedging contracts are then sold, whereas on a weighted average basis, if shares fall by hedge expiration in 2 years, they have to fall on average 19.8% in order for these shares to be put to you, meaning in order for you to buy shares at this lower contractual price. In exchange for you entering into this obligation to potentially buy shares at an average discount of 19.8% to where shares are currently trading, you receive hedged income today, which is equal to 15.6% of your stock portfolio. This is your guaranteed hedged income to keep come hedge expiration in 2 years, so long as you maintain this portfolio until hedge expiration in 2 years. Additionally, for the cash that you hold in your portfolio as the potential collateral to buy shares if they fall to lower prices by hedge expiration in 2 years, you receive interest income on the cash held. This portfolio example assumes that the interest that you receive will be equal to 2% a year for 2 years to total 4%. This means that your maximum potential return for the portfolio over the 2-year investment horizon is the sum of hedged income, 15.6%, plus interest income on your cash held of 4% for 19.6%. This is the inherent limitation of the strategy. If shares rise to any degree, remain unchanged, or even fall moderately, the maximum return that this portfolio can generate is 19.6%. So if all portfolio shares were to rise 50% over the next 2 years, then the limitation of this portfolio is your return is capped at 19.6%. The benefit to the strategy is if shares do fall by hedge expiration in 2 years, you can buy shares, but shares have to fall on average more than 19.8% in order for you to have to buy shares. If shares do fall and fall below that threshold, then you have a further degree of downside protection or a buffer of protection from these contractual purchase prices until the threshold in which your portfolio would lose money over the 2-year investment horizon. The difference is the downside threshold of 19.8%, so that's the degree that stocks have to fall in order for you to have the contractual obligation to purchase them at the lower price, plus the hedged income you receive of 15.6%. So 15.6% of hedged income would then transfer to further insulate your downside protection for the portfolio. The 15.6%, in addition to the downside protection threshold of 19.8%, translates on a rounded basis to 35.7%, meaning that portfolio shares have to fall on average more than 35.7% by hedge expiration in 2 years in order for this portfolio to lose money. Let's take a look at this portfolio in table format and with dollar amounts. A quick recap for the percentages is the $2.5 million hedged stock portfolio with a 2-year investment horizon has downside protection of 35.7%, generates hedged income of 15.6%, and receives interest income of 4% for total potential return of 19.6%. The amount of downside protection with the profit still being optimized is 19.8%, meaning that portfolio shares on average can fall as much as 19.8% in order for the strategy profit to be optimized at 19.6%. What does this look like for dollar terms? For dollar terms, the $2.5 million hedged stock portfolio generates hedged income of $389,840. This is your guaranteed hedged income to keep so long as you maintain the hedged portfolio until hedge expiration in 2 years. This hedged income is yours after paying our bespoke TFC Capital fiduciary investment advisor fee of 1% of assets under management for the 2-year period, equal to $50,000. So after paying our $50,000 fee, the hedged income you keep is $389,840. Additionally, on the cash held for this 2-year investment horizon, the interest earned, assuming a 4% interest rate or 2% a year for 2 years, equals $100,000, meaning that the net income that you keep after paying our fee, and there are no other fees, is $489,840 set against a $2.5 million hedged stock portfolio. Let's take a different path here from most traditional advisors, and let's spend more time looking at the investment advisor fee that your capital pays to us, bespoke TFC Capital, for structuring this portfolio for you. The total fee that's paid, our investment advisor fee, is 1% of assets under management. That's $2.5 million times 1% is $25,000 times 2 years for $50,000. After paying our fee, this is the income you receive, $489,840. Think of it this way. Standard issue for a fee to a traditional financial advisor is 1% of assets under management, meaning that you would pay $50,000 approximately to other financial advisors. However, they then turn around and put you into passive investment funds, which have additional fees, meaning that you are paying hidden fees that you may be unaware of. In the traditional financial advisor investment structure, if portfolio shares fall, then you lose money. Let's just say we're in for a really challenging 2-year investment horizon, and say you invest with a traditional financial advisor and your portfolio shares on average lose, call it $489,000, then the amount of money that your portfolio will lose over a 2-year investment horizon is, with a traditional financial advisor, the sum of the loss, in this case of $489,000, plus the fee you pay the advisor of $50,000 for approximately $539,000. With this hedged portfolio, given that this income that you keep is $489,000 after paying our investment advisor fee of $50,000, if portfolio shares on average lose $489,840, then this portfolio net return is zero. There's break even. Now, on the flip side, if portfolio shares do rise, there is an opportunity cost incurred, meaning that if portfolio shares rise and rise to a degree that is greater than 19.6% over the next 2 years, then this portfolio will underperform a stock ownership only portfolio that would have risen more than 19.6%. The trade-off is that this portfolio provides significant downside insulation, which means that you should hopefully feel more confident about your investments when inevitable stock market volatility occurs. Additionally, one last point is that this hedged income generated of $389,840 is a long-term capital gain and is taxed advantageously. As I mentioned earlier, this more than likely is a new form of hedged income stock investing that you probably have not been presented before. If you're still with me at this point in the video, thank you, and let me know in the comment section, as I put a lot of work into these videos and having your comment would be appreciated. A few notes here now for disclaimers. So the portfolio that I've referenced today was recently posted to our website at bespoketfc.com. The terms of the portfolio literally change in the market on a minute-by-minute basis. The reason I reference these specific numbers is because this is a portfolio recently posted to the website, and I just have to pick a number and run with it at one point. These terms change all the time, and this video does not constitute investment advice. Additionally, the strategy deployed in this video does not have to be uniform across a portfolio. If you are interested in investing in the stock market, you can even have different hedged strategies deployed. This is the most risk-averse or most conservative hedged stock income investment strategy that we deploy. You can receive a customized portfolio that has a combination of this strategy of selling cash secured puts, along with other hedged strategies or stock ownership only strategies, whatever you like. We customize portfolios for clients for that flat fee of 1% of assets under management. Once again, this does not constitute investment advice, though. Thank you for watching. If you have any questions or comments, leave them in the comment section. Like and subscribe, and thank you for watching.